Spotlight then for this evening. The International Monetary Fund released a report last week where it said that it expects the Asian economies to continue to fuel global growth despite being weighed down by a slowdown in China. According to the IMF, domestic demand has remained resilient largely throughout most of Asia, supported by rising real incomes, especially in commodity importing countries and supportive macroeconomic policies in many of the regions. The Asia-Pacific region is expected to grow at a strong 5.3% this year, accounting for nearly two-thirds of global growth. The IMF is also forecasting India will remain the world's fastest growing large economy, set to grow at 7.5% this year and next as it benefits from lower oil prices. And for more on that today and to really understand how all this is going to pan out in the Asia-Pac region, I'm joined by Kevin Sneeder. He's the Asia chairman at the McKinsey & Company. Kevin, thanks very much for joining us here on The Big Picture. Let me straight away start by asking you about the Chinese economy, because we saw earlier this year and sometime last year, there was a lot of trepidation, there was a lot of concern, a lot of turbulence when we saw the capital outflows increasing, which also forced eventually the government to devalue the yuan. Since then, have things settled down as far as China is concerned?
The Chinese economy is in transition. I do think it is more stable than the several months ago shocks that you described. But we should not be surprised if there continue to be some ups and downs. And I say that because the reality is the path from an economy that has fundamentally been industrially based, that has been one where there has been heavy economic intervention, to one that is more services and consumption based. The world has not seen that transition happen without turbulence, and I don't think there's any reason to believe that it's going to be different this time around in China. And so I think we have to prepare ourselves for a degree of volatility, that even though in China you have a state apparatus that controls more of the levers of the economy, and therefore has more of an ability to manage that transition than in other geographies, the reality is transitions don't come without some pain. And so I think the world indeed needs to readjust expectations. I don't think we're about to see the proverbial hard landing, but I do think we're going to see some volatility and choppiness in growth rates, and that is not going to be smoothed by massive intervention. It's going to occur. And instead of questioning where that leaves us on any day, we need to look at the bigger picture and remind ourselves that this is an economy that will still be growing somewhere well north of 450 basis points for quite some time, that will see a continued development of its consuming class, and that will remain a major centre for manufacturing and industrial production for years to come. And if we remember that, then the volatility needs to be considered in that context.
So then you're saying that despite the choppiness, China will continue to grow. Then that leads me to my next question, because I remember in an interview last year you had said that you expected China to remain the fastest growing economy in the world. Since then, a lot has happened. Do you still hold that view, Kevin?
I maintain the view that China's absolute growth will indeed be that which powers the rest of the world. I think clearly from a percentage rate point of view, well, India is well ahead. So I don't believe that the percentage will be the highest. But I think the sheer size of the Chinese economy means that we need to be less fixated on percentages and more fixated on some of the enormous numbers that are coming out. Let me give you one example of that. If you take robotics, everybody talks about the challenge to Chinese manufacturing as the world automates. Well, the reality is China is already 25% of the demand for robots globally. And that means that if you actually look at it in terms of robots per worker, well, China's at 36 for every 10,000. That's a low number. But in absolute terms, it's 25% of the world's demand for robots. And if you think of the Chinese government's goal of getting that number from 36 to 100, well, that percentage is only going in one direction. It's going up. And I think that's the point that we need to remember, and frankly is good news for the rest of the world, which is the absolute scale of demand in China remains vast. And if we keep our eyes on that and get less fixated on the percentages, then I think you get a truer picture of the importance of China to the world's economy and indeed to all of Asia.
Fair point there. We shouldn't be fixated on the percentage growth and look at the Chinese economy in its entirety. But in the past, you've talked about how investors need to now start taking geopolitical risks into calculations and into their account. Now, in light of the tensions that we've seen in the South China Sea, we've recently seen the Hague judgment, and where there is no indication that China's belligerence will reduce anytime soon. And there's a lot of concern among many Southeast Asian economies. So in that context, how do you assess these geopolitical risks to China and the rest of Southeast Asia?
I'm not a politician, and therefore I hesitate to go too far down the offer of commenting on the geopolitical aspects of China's relationships with the rest of the region. But what I would say is this: the geopolitics of Asia in some way get well overshadowed by the geopolitics currently facing the European Union, the Middle East. What I have written about and observed is that the reality is, for all business leaders these days, wrestling with those geopolitical issues are real, and making sure that you at least factor them into your decision making is important. But the specifics of China's relationships with the rest of Asia, I leave for others to comment on.
Well, also let's talk about Brexit. How do you see, Kevin, the impact of Brexit panning out across the major economies in Asia?
I think Brexit is somewhat misunderstood at one level and overly understood at another. I think the angst over the narrow economic impact of Brexit is well overstated. I'm from the United Kingdom. I believe in the United Kingdom, but in reality its trading importance isn't all that it's cracked up to be. And I think that's the part of Brexit that's overstated. The part that cannot be overstated, though, is what lies behind Brexit. The degree of the populist movement gaining strength across the world, and indeed in the United Kingdom and beyond. The challenge it poses to the concept of globalization and free trade cannot be overstated. And it's that which gives me most concern, because this part of the world essentially has been the hub of global trading for many, many years. And if that starts to get peeled back and we're actually going to return to localism, then I worry. I worry about the world and its stability and the growth prospects that it has. And that, to me, is the challenge of Brexit. I could easily say to you that in the near term, Brexit creates a wonderful opportunity for people to make acquisitions of companies with asset values that have been depressed. That plays to the strength of those who haven't got the pound as their currency. And it creates a real opportunity for Indian business. But at the same time, I wonder and worry about whether it heralds a return to a more parochial view and a narrower view of trade. And that would be a problem.
So, well, through Brexit and also with Donald Trump, we are seeing this anti-globalization rhetoric getting very, very strong. And also we've seen in the recent past, over the last few years, in fact, how global trade growth has actually been less than the global aggregate demand or the global GDP. In such a situation, then, Kevin, do you feel that these factors now pose a risk to those countries who still want to pursue an export-led growth model?
I think there's more challenge to that model than we've seen for many, many years. So yes, there's real risk. At the same time, I think what is and may happen is that people realize that actually going down this path is not going to lead to the kind of economic development and indeed the harmony that one wants behind that economic development of nations working together. So I think there is a case to be said that the response needs to have several elements to it. One element is actually to hear the message loud and clear, that the relationship between business and society, the inequalities that perhaps have given rise to this wave of populism do need to be addressed, and business and government, of course, have an important role in addressing those. At the same time, in return for that recognition and responding with actions, I would hope that there's also a sense that we cannot allow the flows that occur, the economic ties to be broken and unwound, and return to a world in which it's all about local protectionist approaches. But both of those need to be true. It's very important that business faces into its responsibility to the broader society and helps address this inequality. And it's equally important that politicians and business together make the case for global trade links and show why that actually is the way in which the world economy will prosper, not by turning our backs on each other.
Well, let's get you talking a bit now on India then, Kevin, because last week the upper house of the Indian Parliament actually passed the GST bill. Today, the lower house passed some of the amendments to that GST bill. Give us your reaction. What does it mean, to the global investors looking at India because of the single biggest tax reform that India has brought about?
Well, this is a long heralded measure, so we've had plenty of chance to hear people comment and hope that this would herald an approach which, one nation, one tax, creates more opportunity to work across boundaries, provides more clarity on the tax rate and the tax system, provides a real boost to the economy. There's lots of reasons for optimism. At the same time, the measure isn't yet enacted. Clearly, the rate itself hasn't been set, and there's some real work to do to help with the particular parts of the country that will see themselves being net losers under this approach. But I think the grounds for optimism are there. And certainly as I talk to people today and talk to international companies looking at India, this is an important milestone. People were looking for something big. They were looking for a structural change to go with the world's enthusiasm for India and its prospects. And so this has real impact on the way people see India. It will have real impact on India if it's enacted in a way that allows for the promise of one nation, one tax to be turned into a reality that boosts trade across boundaries, makes it easier to do business in the country, and that indeed stimulates demand on the back of a far more equated point of view when it comes to tax rates. So lots of reasons to be optimistic, I would say.
Would you then say that this has reassured the optimism, reassured global investors, about the reformist credentials of this NDA government led by Prime Minister Narendra Modi?
I think so. I mean, let's be clear. The way in which India is now seen has gone through many iterations. But in truth, there is a lot more positive approach and mindset towards India. It started to get a little bit frayed. People weren't so sure. There have been some leadership changes, as you well know. And I think people were questioning it. This gives the prospect of reigniting that interest and making sure it's sustained, because this feels like the kind of structural change that, frankly, commentators, business alike, have been waiting for.
Well, indeed, Kevin, as somebody once said, that India has managed to disappoint both the optimists and the pessimists. But thank you, and appreciate you taking your time out and being part of the show. But